in the last class, we established chapter 1 and some foundational concepts on the case study paper. So we'll be building on that foundation, and critically we'll be looking at chapter 2 today. And chapter 2 is an integral part of the case study paper, which has been tested frequently as requirement 1, frequently. Just a few diets where he deviated and swapped it either to requirement 2, but predominantly he has tested financial statement analysis in requirement 1. So chapter 2 speaks graphically and elaborately to financial statement analysis, and we'll be looking at the contents, which is quite all-encompassing. We have 2.0, which is the purpose, looking at the purpose of the financial statement analysis. And we have 10 long units. The first one, an introduction to financial statement analysis. The second unit, the spectrum of financial statement analysis. The third unit, speaking to introduction of financial statement analysis in the case study exams. The fourth unit, speaking to the definition proper of financial statement analysis. The fifth unit, the types of financial statement analysis. The sixth unit, techniques for financial statement analysis. The seventh unit is ratio analysis. And the eighth unit, financial statement analysis in the case study exams. And the ninth unit is how to use financial statement analysis for your case study exams. And finally, the examination focus. So it's a long, detailed chapter, and we'll be looking at it. And after this chapter, we'll be taking one past question. Remember, we said after every 2 chapters, we'll take one past question. So we'll be looking at a past question after we've treated this chapter to help us understand early how to look at and answer the case study exams. We will not go through the lectures from chapter 1 to 11, and most of the time we've forgotten what we've done from chapter 1 and 2, especially when we get to chapter 11. It's good we take the past questions intermittently. After every 2 chapters, we take one past question, and it will help resonate with us as we are treating the subjects. We are treating past questions to help us get prepared before the pre-scene or any mock exam we'll give comes forth. Okay, so what is the purpose of the financial statement analysis? The purpose is to explain what the types of financial analysis, what financial analysis is as required in the case study exams. Another purpose is that we'll be looking at the various techniques, what and how to go about financial statement analysis. What techniques, what methods should we use to analyze financial statements? Then we should understand the use of these financial statements in the case study exams proper. So practically, that's what we'll be looking at, and that's essentially the purpose of the financial statement analysis in the lectures. So we'll be looking at Unit 1, having spoken to the purpose very briefly. Unit 1, let's introduce financial statement analysis. What is financial statement analysis? Financial statement analysis speaks to the analysis, the evaluation, the dissection of financial statements. And the case study exams requires business analysis from multiple perspectives. So financial statement analysis is actually a core required skill, a core required professional skill. And this chapter will be elaborating on that. So financial statement analysis is very essential, and it's also related to financial data analysis in the sense that financial statement analysis deals with the FS or the content or components of a company's reports. While the financial data analysis is also a core skill which we'll be looking at in chapter 3, and it has to do with non-financial information, non-structured data, and also calculations that permeate around strategic financial management, performance management, and some other information and calculations that we'll be looking at critically in chapter 3. So financial statement analysis is the subject of this class or this session, and they are also related to operational and strategic analysis, speaking to business trust and ethical awareness that we'll be speaking to in chapter 5 and chapter 6. We'll be analyzing current context and activities around operational and strategic duties of a company. So in performing financial analysis, integration is key. That means you need to combine analytical perspectives into an integrated whole. What does that mean? It means that in performing financial statement analysis, financial data analysis, operational and strategic analysis, you need to integrate them, synergize them, not just analyze them in silos, but bring them all together and combine the perspectives into an integrated whole. Remember, you are preparing just one report in two different requirements. So integration is key in the case study exams. This is very important. Integration is key. So the interrelated timelines, speaking to financial statement analysis, speaking to past performance. Financial statement analysis, speaking to past performance, is what we do. Financial statement analysis is not futuristic. We are not looking at prospective information. We are looking in retrospect. We are looking at what the company has done historically in the past. So essentially, financial statement analysis deals with past performance. So currently, we are in 2025, for example. If you are given financial statements to analyze, you'll be given from 2024 downwards. You can't be given 2025 because 2025 is not yet done with. Also, please feel free to interject. If I said something or something on the slides you don't understand, please raise your hand or feel free to interject, like my good friend Zachariah normally does. If you have something confusing, just interject to get clarity so you can catch those thoughts. All right, so speaking to past performance on financial statement analysis, financial data analysis speaks to current issues. It could be a project, an appraisal that you are given as a chartered accountant to analyze. There's a project and they want you to use NPV analysis as the board may require. Let's see, you help us with the viability of the project by calculations and explanations the same. So this is what financial data analysis is all about, and they come predominantly in requirement 2 of the exams. Also, the operational and strategic analysis speaks to general operations, strategy formulation of the organization, and they are either present or futuristic in context. So they both permeate around past, present, and future performance. So operational and strategic analysis speak to those areas. So that's generally an introduction into financial statement analysis and what it looks like and what we're going to be looking at critically in this subject or in this chapter. So let's look at the spectrum of financial statement analysis if we don't have any questions or clarifications. The spectrum of financial statement analysis speaks to an assessment of professional skills of ICAN chartered accountants. So as candidates on the way to qualification, your professional skills in this area is the objective of this paper, to assess it and to ensure that that skill is harnessed. And the scope speaks around analytical review of financial statements, viability and assessment of projects and actions, and future proposal assessment of a client's books. So typically in the case study exams, you have financial statements to analyze and you have projects, actions in form of financial data analysis for your assessment, scrutiny for your analysis, for reporting. So the scope of the case study exams permeate around this, and your professional skills is essential, is integral, is important to be able to speak to these areas for clients as an advisor So this your advisory role is important in performing calculations and explanations. So the scope permeates around financial statement analysis and financial data analysis. So we'll be covering the coverage speaks to past performance for financial analysis, then for current operations to future strategic actions. So for current, you speak to financial data analysis, then for current and future, you speak to operational and strategic analysis. So that's where it covers. So it ranges between a single revenue stream to the whole organization's investment opportunities. And that's what the financial statement is all about. The revenue speaks to the first item on the SCI or the income. Then you talk about the organization as the whole, its expenses, its investment, its position, its cash flow, and other non-financial data is what this range covers. So, in conclusion, speaking to the spectrum, expertise in financial statement analysis is a necessary skill. So you need to be able to analyze financial statements from a bird's view, from initial analysis to detailed analysis. This is very important. And that's what the spectrum speaks about. So from receiving financial and non-financial data, you should be able to analyze it, check the range, check the coverage, and look at what the financial statement speaks to in the past, presently, and in the future, and what you are required to advise your client. So that's it for the spectrum of financial analysis in brief. And we decide to make it very brief so that it doesn't become boring like the study text. So you need to also go through the study text to use these videos to read your study text. The study texts are more elaborate, but these lectures, I will pick PowerPoints from the study text to be able to help paint a picture and give you bullet points that will resonate with you and help you catch a glimpse of what the study text says. So we're not substituting these lectures for the study text or the slide. You still need to go through the study text, and gladly the study text is not voluminous like SFM, like CR, that is over 1,000 pages. It's just 267 pages, and with 2 hours, you should be able to finish the study text in 2 weeks. You can read the study text even twice before the day of the exams, just 11 chapters. So I would suggest, please, you go through the study text after the lecture so that you can be grounded in the concepts and the foundation and the understanding of critical matters or subjects and the chapters in detail. So we'll be looking at the third unit of the financial statement analysis, speaking to an introduction to financial statement analysis in the case study. We'll also have a unit that goes in detail, but this is just an introduction. How is financial statement analysis presented in the case study exams? So you must understand that financial statements are numerical summary of business activities. So speaking to the SFP, the SCI, the SCF, they are all numbers. They are numbers that spoke to the performance, to the position, and to the cash flow of the business. So a critical skill for a chartered accountant or an ICAN candidate is the ability to read, to understand, to evaluate and explain these financial statements to a client. So don't forget, most clients are not accountants. They don't have financial literacy. So that's our job as chartered accountants, and the skill to be able to explain these seemingly complex financial statements or documents or components in decipherable and comprehensive manner for clients. So when you talk about revenue, you're speaking to income, your language and the way you communicate to clients is very important. And this is a critical skill that the case study exams helps you to hone and to harness. It's very important. So the ability to read, number one, understand, number two, evaluate, number three, then critically communicate in form of explanation of these same financial statements to a client is a critical skill for a chartered accountant. Please take note of that. And the exam focus explicitly speaks to testing this competence in financial statement analysis. Our ability to understand, evaluate, analyze, and present or communicate succinctly during the exam is key to passing the case study exams. Take note of this. And in demonstration, you need to show this critical skill by offering clearly explained analysis. So your numbers are not enough because some numbers could be confusing. So what does those numbers mean? What do they mean in simple language? What do they mean to a layman? So the professional evaluation of these numbers is very critical and very important for clients to draw conclusions. And when this professional evaluation of the numerical information is provided, it should lead to very, very comprehensive conclusions and implementable recommendations for the clients. So you're not just analyzing, you're also stating what is obvious in form of conclusions, and you are stating what you are recommending should be done to either ameliorate the issue or move the company forward in form of you're just adding value to the client by solving problems. What is value? Value is proposition that solves problems. So a problem is presented to you and you're providing solution to the client in very simple terms. So logical conclusions and implementable recommendations are critical skills, and they are graphically painted in how you write the case study exams. So for example, one of the boxes speaks to conclusions and recommendations. If you don't provide conclusions and recommendations, despite your analysis and explanations, you cannot pass case study. It's clear. Very important. So take note of that. And that is an introduction into the case study. We'll be going into a detailed analysis of the financial statement analysis in case study in a subsequent chapter. But this is just to have a brief overview of what financial statement analysis is and what it will look like in the case study exams. So let's define financial statement analysis. The evaluation and explanation of financial and related information in financial statements, speaking to summaries, notes to the account, management account, budgets, forecast, is what financial statement analysis is. So explanation of financial and related information in financial statements is exactly the definition of financial statement analysis. So you are evaluating. After evaluating or analyzing, you are explaining this financial and non-financial data, either in words or in writing. Mostly in the case study exams, you are communicating in writing. So it includes summaries of any financial statements, whether management accounts, SCIs, SFPs, note to the account, and any related information in form of budgets or forecast is what financial statement analysis is. It covers financial performance, the income statement, the statement of comprehensive income, the statement of changes in equity, the financial position of the entity as at that period in time, and the cash flow statement is what financial statement analysis covers. The contextual information speaks to always consider the company and the operating environment when you're analyzing financial statements. So don't analyze financial statements in silos. Look at where the company is operating from, its industry, the sector, and the macro and micro economic environment is very important in contextualizing your analysis. What's the purpose of this is to identify the strength and weakness, which speaks to the internal capacity of the company, by establishing relationships between the SFP, which is the statement of financial position, and the statement of changes in equity elements. So the strength and weaknesses of an organization are internal, while the opportunities and threats are external. So the strength of the organization's performance and position are in the SFP and the statement of changes. So you need to look at the interrelationship when analyzing the financial statements. Then you determine key performance indicators like their liquidity position. How are they able to meet short-term obligations between 1 month to a year or something? How are they able to meet, how are they solvent, meet long-term obligations between 1 to 5 years? Their debt and equity mix. Also, the profitability is how are they able to make profit to run the organization, from revenue, looking at their cost of sales, direct expenses, and their gross profit, talking down to their operating expenses, their bottom line, net profit. So you're looking at the profitability of the company from the SCI's perspective. And also efficiency, speaking to how they are able to manage debt, and their equity is what efficiency speaks to. And their investment also is another area that you speak to, looking at their earnings per share, and all that. Will be coming to that in one special unit. So the evaluation of long-term and short-term prospects is also very important in understanding the definition of financial statement analysis. So the long and short-term prospects of the company. Drake said financial statement analysis is the selection, evaluation, and interpretation of financial data to your client to assist in investment decision. So this authority said this, adding that whatever it is you're analyzing should lead to decision making, especially in the area of investment for clients. This is very important. So the contents of financial statements we are aware of. We have the statement of comprehensive income, speaking to the traditional profit and loss account. We call it income statement. And we talk of the balance sheet traditionally, which is the statement of financial position or the position statement. And we speak to statement of changes in equity, speaking to the movements in equity and reserves of the company. Then we have the cash flow statements of the movements on how operating, investing, and financing activities are permeated around this statement. So why is this analysis of financial statements essential? It's because raw financial statements data is not enough for meaningful conclusions. They are good for publications, but you can't conclude on them. So analysis measures efficiency, profitability, financial health of a company, and future prospects. So it's very essential, and that's why chartered accountants are required to bring out meaningful conclusions and recommendations from this raw financial data. It's very important. And also the focus is to diagnose past performance, which is the financial statements that has been prepared, and also to look at the present, and also speaking to the present performance, the position, and gain or glean insights into future prospects. This is very important. So with what the company has done, the trajectory, its antecedents from the history of its financial statements, you could draw insight into what it will do in the future. And that's what this focus is all about. So for prospective dependent users, like investors, they need to predict the company's future performance or the firm's performance. That's why a lot of people depend on the financial statement analysis to predict the future of that company. And also management want to understand the present condition for planning purposes, for budgeting, for forecasting, and understanding their performance and their condition, and how to plan for the future in perpetuity. This is very important. So the objectives of financial statements is to facilitate the evaluation of the business strength and weakness. Don't forget I said the strength and weakness is internal. So the analysis of financial statements is to evaluate the business strength and weakness. Are they maximizing their strength, or their weakness is overpowering their strength? And financial statement analysis helps to facilitate this. Also, the measurement of profitability is also an objective of financial statement. How profitable is the company? Without profit, a company has deterred its first objective. One of the main objectives of going into business is for profit. So measurement of profit from the financial statement is very important. Also, the objective is to check patterns and the trends of performance of the company over the years, mostly 5 years, comparing 3 years, 2 years at times, to see how they've done. And also another objective is the determination of the future earning capacity of the company is an objective of analyzing financial statements. Then also comparing with other companies in the industry, in the sector where it's domiciled. It's also an objective to see how they are faring among their peers. This is key. Another objective is the determination of liquidity, which is short-term and the ability to meet obligations, and also the solvency, the long-term ability to meet obligations of the company. And also the assessment of the growth potential. How are they able to grow revenue, grow value, and also grow the wealth of the owners, the shareholders. So assessment of growth potential is also an essential objective of financial statement analysis. So for the case study purpose, you are examined and tested, and your abilities, the ability to select, analyze, and interpret information, and also to make informed decision on the past, the future, and the financial condition and operation or operational performance is what the case study is all about. So you are tested and examined by the examiner to see if your skills, professional and communication, is able to analyze, interpret, and make informed judgment on the past retrospective information, the current and also prospective information and condition of the company provided to you. So data sources for financial statement analysis or for the case study exams typically speaks to financial statements data, market data, economic data, operational data, and relevant events from articles, from what's happening in the economy. So we don't have just numbers in the data sources speaking to the exhibits that will be provided. We also have non-financial data sources embedded in those documents for you to read and bring out meaningful conclusions and recommendations from them. So in communicating, a qualified candidate that would become a chartered accountant very soon must analyze and communicate clearly to a client or a recipient. This is very important. So clear communication and communication skills is essential. A lot of people have ideas, they have what it takes to pass case study, but communication is a challenge in writing. Some people, if you look at their handwriting, man, is appalling, it's horrible. It's hard to read. And that is why I think one of the advantages of those that have bad handwriting will be this computer-based migration or transition. So if they are good on the computer, they can type very fast. They'll be able to express their thoughts or communicate clearly, maybe with the computer. Because one of the challenges with markers of the examiners or those that mark the script is the handwriting of candidates. So if you have this challenge and you know writing is your problem, and maybe by November, ICAN has not transited for professional stage to computer-based, please work on your handwriting, because just handwriting could get you to fail the case study paper. And a lot of people know how to pass it, but communication is a challenge. So you need to work on communication skill. How do you work on that? Please practice writing. You need to write frequently. It's very important. So that's it about the definition of financial statement analysis and what it speaks to on a general note. Okay, so we've ended 4 units out of 10 very fast, and that's in 30 minutes. Do we have any questions? I want to be speaking and hoping you guys understand what I'm talking about. Any questions so far on the 4 units we've just looked at? I hope we are understanding what we are looking at and how we are speaking to the slides. We are silent. Somebody should maybe give a feedback. I hope we are getting what we are saying. You can unmute and speak. Okay, yes.
Okay, sorry, sir. I just came in actually, but what I meant, I think I was able to grasp what I saw you explaining. So I think I'm fine with it.
Okay, fantastic. Thank you, A, for that feedback. Thank you. It gives me the assurance that we are following. Okay, so let's look at Unit 5, the types of financial analysis. Types of financial analysis. So we have different types of financial analysis, and the first one is the external analysis that is performed by external parties based on published financial statements. So external analysis speaks to those that are external of the organization. For example, you are given the financial statement of XYZ and Co. Limited, a manufacturing company, but you work for an audit firm where you are either audit senior, so you're performing external analysis. That's an example graphically of what external analysis is. An internal analysis is performed by an entity's manager for top decision making. So if you look at the format of the case study report, we have the internal and the external kind of memo. So this financial statement analysis is a graphical example of that. So if you're external to an organization and you're given the IFS to analyze, it's an external analysis. But if you're internal and you're a manager and you're asked to analyze the financial statement for decision making, it's an internal analysis. We also have short-term analysis, and this focuses on working capital, the day-to-day running of the business, short-term liquidity, and the cash flow, how cash is utilized and generated for the business on a day-to-day basis. So we have short-term analysis, and it's performed by accountants, financial analysts, chartered accountants, to see how the current position is, what are the issues, what are the metrics. There are benchmarks. So for example, like the current ratio should not be less than 1:1 or 2:1 for a comfortable cash flow or short-term working capital position. So we also have the long-term, speaking to the analysis of capital, debt and equity of the company, looking at its viability and how it's able to meet debt obligation in future.
You know upon the long term?
Yes, I think it's not on this slide.
Okay.
It's not on this slide.
Okay. It's okay, sir.
Yeah, thank you for that. So just take note of it. It's not on this slide. So long-term analysis speaks to the solvency, the debt, the mix between debt and equity of a company. Then practically that the areas that are tested mostly in the case study exams is horizontal analysis, speaking to dynamic analysis. And this is a comparative analysis of the financial statements over the years. So you're comparing 2021, 2022, 2023, 2024, 2025. So it could be a 5-year analysis, and you're comparing horizontally what the company has done, whether up or down for the past 5 years. And the vertical analysis speaks to a static analysis, and the ratio calculation is based on a single year's financial statement. So you're comparing common size statements on the financial statements, the revenue, the cost, the gross profit, and every item down, for example, in the SCI. The same thing with the SFP and the SCF. So the vertical analysis speaks to a single CS analysis. And those are the critical types of financial statement or financial analysis typically. Okay, so if we don't have any questions, we look at Unit 6, talking about the techniques for financial analysis. What techniques, what method should be employed in performing financial analysis? So A is comparative financial analysis. You're comparing financial statements over 2 years, which is mostly presented in the case study exams from pre-seen to unseen. You have either 2 years financial statements or 3 years. Very few diets he has brought maybe 5 years financial statement analysis. Most of the time, 2, 3, maybe 4 or 5, a few diets. And the comparative analysis reveals the operational performance and direction and the effect of assets and liabilities, profit and expenses on the business over 2 years plus period or 3 years. You also compare entities financial statement analysis as a benchmark or an industry average for 1 year period or the absolute or percentage changes between these entities that operate in the same business space with the company you are analyzing. So that's it. Comparative analysis is predominantly what is examined in the case study paper currently. We have common size analysis where you convert figures of financial statements to percentages. So you're checking the common size of items in the financial statements. So you have the income statement where the revenue base is 100. Then you're looking at what cost of sales percentage is. So if your revenue is converted to 100%, and let's say your revenue is 100 million, that's 100%. Your cost of sales is 60 million. Your cost of sales, looking at common size, is 60% of your financial of your income statement. So the same thing is having a base for the balance sheet or the SFP. So common size analysis converts figures to percentages to see which component of the financial statement or item on the financial statement is drawing a lot of weight, and this will help management to check or checkmate such areas. So income, common size statements are predominant in financial statement analysis, and there are also types of financial statement analysis. So like I said, the statement of financial position, the total assets speaking to current and non-current is the base, 100%. Then you look at liability items, current and non-current, share capital, debt, and other items as a percentage of this component. So statement of financial position analysis is statement of financial position is also a common size statement analysis we perform. Then we have the statement of changes in working capital and analysis of cash flow, and this explains changes in working capital speaking to the difference between your current assets and your current liabilities over a period of time, and you break them down by the current asset changes. We also have the trend analysis, which is very important and is an analytical skill for you to be able to understand trends over the years, whether upward or downward. So you choose a base year, for example, 100 for all figures, and calculate the percentage change for other years relative to the base. So trend analysis then changes between, let's say, 2021 and 2022 in form of percentage to see the trend of how the company is going up or down, and is used to determine if financial health and operations are improving, that is up, or deteriorating, down over time. So trend analysis is very important, and it represents a significant part of the analysis box, analytical skills box, which is the third box in the financial statement. So in the next class, after this financial statement analysis, we will look at an example. So all this theory we are talking will resonate with you as we look at that question. So it's important you understand the concept and you're following. Then when we come to analyzing the past question in the next class, which we said after every 2 chapters, we'll look at one past question, the full report. We'll prepare the full report, explain the full report, and share the document with us. So all these theoretical aspects may sound like Greek But then when we come to solving those questions, you see how they apply very graphically. Also, ratio analysis, which is most popular and what you do in the exams, shows the relationship between individual or group items in the financial statement. So the group speaks to profitability ratios, liquidity ratios, activity or efficiency ratios, and also leverage or shareholders or investment ratios. So it highlights key performance indicators and changes in financial conditions. This is what ratio analysis does. So those are the techniques for financial statement analysis, and that will be it for this unit. Any questions so far? 6 units and we are running. Okay, I believe our silence means we are getting it graphically. All right, let's look at the popular ratio analysis in Unit 7. Ratio analysis in Unit 7. Ratio analysis are mathematical relationships between two interrelated variables. So it could be a variable in the SCI and a variable in the SFP. So you could have revenue as a numerator, and you have inventory as a denominator, or receivable as a denominator. So ratios are relational in nature. So they don't operate in silos. You need to calculate them and synergize to get results that are interpretable. And accounting ratios. Yes, please. Yes, please.
Sorry, sir. This analysis, sir.
Yes.
Once you are told to calculate, to make financial statement analysis, if it's trend analysis, they're going to tell you use trend analysis, or if you calculate if you calculate your ratios, are you supposed to do trend analysis, or how does it come up? This question of trend analysis, sir.
Okay, so good question. So in the requirements, when you hear the examiner say evaluate the profitability or the solvency or the performance of the company and advise. So when you hear evaluate or analyze, so there are statements he makes about profitability and some metrics or areas that you will need to perform trend analysis. So when you're speaking to evaluating the performance and you have a 3-year financial statement, you will need to look at the 3 years, and that's where trend analysis comes in. So in answering your question, you may not be asked to perform trend analysis, and most requirements don't ask you. But then when you read in between the lines and you look at past questions and how he has treated such areas, you will see that when he says evaluate the performance of the company in requirement 1, he's telling you to do trend analysis after you've calculated your ratios. You look at the 3 years and look at their trajectory up or down. So no, most questions will not ask you to perform trend analysis, but when you read in between the lines, you will know that you need to perform trend analysis. I hope that's clear.
It's okay, sir.
All right. So good question. So please bring them on as we need them. Okay, so we're speaking to accounting ratios. Significant relationships between figures in the SFP and the income statement are what ratios are all about. So for example, return on capital employed, you use profit before interest and tax in your SCI. Then you use capital employed in your SFP. So these are typical examples of accounting ratios, and we'll be looking at them subsequently. Melville also said the measure of a relationship between variables or components in the financial statements is what ratio analysis are all about. So, and the purpose is to assist in analyzing and interpreting, and also eliminating comparability issues, speaking to absolute figures in the financial statement. So in analyzing return on capital employed, you may not be able to do that with just the revenue figure. So you need to know what capital was employed to generate that revenue. And that's why the relationship or interrelationship between these components is necessary, and it assists in analysis. So it eliminates comparability from other variables, and also helps to address issues of absolute figures where components like the revenue cannot interpret a particular ratio or an area, like I said, the rows to you. You want to know the return on capital employed. One figure or one absolute component cannot explain it. So you need to interconnect them and interpret them. And that's the purpose of ratio analysis. So in comparison, the entity ratio analysis helps us compare the entity's performance and position over time. Also, the entity versus its forecast and its budget, the entity versus industry standards, the entity, the subsidiary versus subsidiaries in areas of holding companies or their financial statements, and the entity across business segments and revenue streams. Also, the entity versus either rival, takeover, or targets are areas you could compare using ratio analysis depending on the financial statement you are presented with. Some of the past questions the examiner has tested, which are very challenging for candidates, are area of segment reporting. You see where he brings global businesses, and you have to perform ratio analysis across cross-border engagements. Most diets that come in those forms can be challenging, and it speaks to segment and revenue reporting across different jurisdictions or boundaries. So these comparisons help us to understand the performance and position of the entity in relation to the unique industry or where the entity is domiciled. So the key skill for chartered accountants is explaining what the result mean. So when you calculate return on capital employed and you say the return in capital employed is 10%, what does that mean? What does that mean? So the meaning is very important. And in explanation, you need to tell your client or the audience what cost the 10%, and if in another year it dropped to 8%, what cost the drop? If in another year it moved from 10% to 15%, what cost the upward report result? So the explanation is a key skill for us, and that is why the marking, the appendices, you don't earn marks. I'll be showing us the marking of the appendices. So a lot of people spend time stressing themselves on calculations. The explanations earn more of the marks. Over 80% of your marks are from explanation. And this is the key skill. So explanation is key. Without explanation, you can't pass case study with just calculation. It's very important. Okay, so let's look at another area of the ratio analysis, which is critical to financial statement analysis. Let's look at the types of accounting ratios under the ratio analysis. We'll look at them by construction and by characteristic. So we have coverage ratios, and these ratios show ability to meet obligations. So for example, the interest cover is a coverage ratio. You want to see how you're able to cover your interest expense with what you generated. So typically the interest coverage ratio is a ratio that speaks to the capacity of the organization to be able to meet interest expense from external funds borrowed. So it shows the ability to meet obligations in form of interest. Very important. And it's a type of ratio speaking by construction and by characteristic. We also have return ratios, which measures benefits from resources committed. So for example, return on investment is a return ratio. Return on capital employed is a return ratio. So you are measuring benefits generated from what you've invested. This is very important. Then we have turnover ratios, speaking to how many times a resource generates benefits or revenue from an activity. So you're speaking to inventory turnover, how many times from your sales have you sold inventory you either manufactured or bought to resell. So how many times are you able to turn over? When you hear businessmen say, how many times can I turn over my capital? That's what turnover ratio speaks to. We also have component percentage, talking about the relationships of parts to a whole in a ratio analysis or percentage of ratio analysis you're speaking to. So what's the percentage of gross profit to sales after you deducted your direct expenses, speaking to cost of sales? So the component percentage relationship to the part is very important. This is key. So we have 5 groups of ratios which we'll be looking at. The first one speaks to profitability. We are aware of it, and this assesses the profit level relative to revenue and the capital invested. So profitability ratios measure what comes in from what has been sunk or invested in the business. So you're analyzing and checking, providing numbers to how the business is profitable. Second one is liquidity ratios, which speaks to the ability to meet short-term obligations using quick convertible assets, speaking to liquid assets or current assets, and the net working capital of your day-to-day business to your day-to-day expense. So liquidity measures how solvent you are in the short term. So this is very important. The third one is efficiency and activity ratios, that measures how efficiently assets are utilized. You want to know how many times you are able to generate returns with the assets utilized. Most of them are in times. So when you hear asset turnover ratio, you have inventory turnover ratio, you have accounts receivable turnover ratio. These are all efficiency or activity ratios. And we have the long-term solvency ratio or leverage ratio that shows the capital structure, the mix between equity and debt, and the degree of fixed financing obligations in terms of interest-bearing expenses and the ability to satisfy or meet them. These are what long-term solvency ratios are all about. So looking at critical ratios like debt ratios, equity ratios, debt to equity ratios. These are typically examples of long-term solvency ratios, and they help us understand the degree of fixed obligations, financing obligations, or debt incurred, and the ability to meet those debts. And finally, we have investment ratios, which are also known as shareholders ratios. And the interest is for investors to see how much they are expecting in returns. They've invested in the business in terms of their shares or shareholdings. So what returns, what wealth generation are they expecting? And that's what investment ratios typically speak to. Okay, so in the next 5 minutes, let's look at the short formulas, because we'll not practice any questions here. After each two chapters, we'll be practicing the full diet past questions. So profitability ratios, we have all these formulas right from maybe foundation, or some of us that even did accounting in secondary schools, we have these ratios at the back of our mind. The return on capital employed is a significant and cardinal ratio, a profitability ratio. So we have it as profit before interest and tax as the numerator. And the reason is because your profit before interest and tax is not diluted, it's organic. You've not deducted any interest expense or any external obligation in form of taxes. So you want to see your organic profit and how your capital, which is internal and external. Internal capital is generated by shareholders and external capital is generated by debt. So you want to see how much returns you're getting from both capitals and even your reserves in form of your retained earnings. So everything that has to do with your capital should be the denominator, and your profit before interest and tax expressed in percentage is your return on capital employed, which is a cardinal and important ratio when you are asked to calculate profitability ratios. This should come first in your mind. You can also calculate it as your profit before interest tax or net asset, looking at your total assets minus your total current liabilities. So where you don't want to use this denominator, speaking to your capital, total capital plus reserves, you can use your total assets minus your current liabilities, which can be broken down as your profit before interest tax divided by your sales, and your sales comes back as change of subject formula divided by your net assets to give you the profit before interest and tax over your total assets and current minus current liabilities. We'll be looking at this graphically when we come to an example of one of the questions, past questions we'll be treating subsequently. So the return on equity speaks to your profit after tax. So this is inorganic because you've deducted all the necessary expenses, including special covenants, that is preference dividends. So return on equity speaks to after tax, is inorganic, and you are not looking at external expenses, external funding or capital. And that is why you see the denominator does not have non-current liabilities or debt. So you have just internal internal funding or capital, which is retained earnings or reserves plus ordinary share capital. And the profit after is, after you've deducted expenses, what return does equity holders have? What do they have as a return to them for their investment? So that's return on equity. And we have the popular gross profit margin. These are popular ratios, and the net profit margin. The gross profit margin measures the return after you've deducted direct expenses. And you want to know what direct expenses are taken from your revenue and what percentage comes as your gross profit. So it's a popular and very valuable ratio. And we also have the net profit margin, which is the bottom line, the outcome, what remains after all expenses have been deducted, organic, inorganic, cash, non-cash, speaking to depreciation, taxes, and interest, everything, what remains for distribution. And this is very important for mostly ordinary shareholders. They want to know the bottom line, the net profit, to know if wealth is generated or they don't have anything for their investment. This is key. Okay, so the next ratios or set of ratios in the next 2 minutes, we have to go and break our liquidity ratios. We have these ratios that measure the ability to meet your day-to-day obligations. We've spoken to this in former slides, which speaks to your current asset divided by your current liability to arrive at your current ratio. Yes, please, Sharifat, feel free to interject. Yes, please, go ahead.
Yes, good evening, sir.
Yeah,
and thanks for the lecture.
You're welcome.
Yes, sir.
Yeah.
Now, my question is net profit margin the same thing as operating profit margin?
Okay, very good question. So it's not the same. Operating profit margin is a ratio after gross profit margin. So what are the deductions? Now, when you have your gross profit margin, it's your revenue minus your gross direct expense, which is cost of sales. Then you have your gross profit. Then you have two principal expenses for operations. And the two are admin expenses, either sales and distribution, or you have distribution expenses. So those two expenses are not direct, they are indirect. So after deducting them, you have your operating profit. And that operating profit comes before your interest expense, before your depreciation, before your taxes. And your net profit comes after. So operating expense, admin, where you see questions like admin and distribution or selling and distribution, deduct them to arrive at your operating profit. I hope that's clear.
Yes, thank you very much, sir.
All right.
Sorry,
You're welcome. Yes, please.
Sir, sorry, have we discussed, I don't know, I missed the first lecture. I don't know
Yes,
whether
please.
you discussed how to do the cover page and stuff like that. Have you discussed it?
No. So in the next
Okay.
class, after this financial statement analysis, we'll look at that in a full question.
Okay, sir. No problem, sir.
Yeah. Okay, so let's halt now. This is 9 o'clock. Let's go on a 10 minutes break.